This video is a demonstration of our Yum Brands earnings model. Please keep in mind that this video was created prior to the fiscal third quarter 2015 earnings release, and so the values will update from time to time. Please check our website, gutenbergresearch.com, for the latest updates. So the structure of the model is consistent with our others. In the upper left-hand corner, you see the color guide and share value summary. Anywhere you see a blue cell, those represent our estimates. Purple cells represent company guidance, and orange cells represent consensus estimates. You'll see that we have some columns that are shaded in dark gray. Those represent the historic actual values from the company's SEC filings, and the light gray values represent the estimates for future periods. The model starts with the income statement. Below that we have segment details. Then we have a balance sheet, a cash flow statement, multiple valuation section, and a discounted cash flow valuation section. So if we scroll back up to the income statement, we can see how we actually put the model together and what's driving the earnings. So you'll see that we have some details starting with revenue, and we'll go through each one of these line items. And we have it broken out based on company sales and franchise sales. And so what this calculation is showing you is it's pulling details from the segment section down below. And we can actually expand that section and go through each one of them. So let's start with the KFC details. So for KFC, we need to start with an estimate of the total number of restaurants. So this is in units. It's not in millions, it's not in dollars. This is the total number of restaurants, franchise and license and company owned. So we apply some small growth rates to these to come up with the values that we have here, but you could put your own in if you think they're going to start closing KFC restaurants. Maybe you want to decrease it from last quarter's number. If you think they'll expand quickly, then maybe you want to increase it. Once we have our restaurant number, we want to get to the company sales per restaurant. So we've got $446,000 in sales per company owned restaurant. And that's a sharp increase from last quarter, but you can kind of take a look at how the different quarters work to see what kind of seasonality you would want to introduce. And then you could also consider trends, and if KFC is not doing so well, then maybe you want to decrease that number, or you could increase it if you think they might do better in the future. So then let's scroll back up to our revenue number. You can see that it's just taking the company sales for KFC, which is just the multiplication of the franchise-owned restaurants times sales per restaurant. And it's doing the same thing for Pizza Hut, for Taco Bell, for the China division, and for the India division. And now for India, they don't actually break out the company-owned revenue from the franchise and licensees, so we just take 50% of that number and apply it to each one of those line items. That gets us to our total revenue, and since it's a cell that's shaded in orange, that tells you that it's consistent with what the consensus estimate is among Wall Street analysts. Then below that we have our company restaurant expense line items, and you can see that this equation looks a little daunting, but it's just taking the expenses as a percentage of sales for each one of the segments. So you can see here's the KFC food and paper expense to sales times the KFC company sales. And it's doing that for each one of the divisions, and it's taking an approximation for India similar to what we saw in the revenue line item. So we do that for each one of the company restaurant expenses line items, and that gets us to our gross profit. And then we have some operating expense line items, G&A, franchise and license expense, and some other items. And each one of those is calculated in a similar way based on the segment details. The thing about Yum Brands is it's basically like multiple companies in one. So everything that you do for the segment details is going to roll up to the corporate total, which is what this calculation is doing. That gets us to our operating income on a GAAP basis, and then we have some non-GAAP adjustments. So if you scroll to the bottom of the segment details, you'll see that we have some breakdowns for non-GAAP adjustments. And going forward, we're estimating an impact of just $10 million per quarter, but you could change those items if you'd like. That gets us down to our income before taxes. We apply effective tax rate to get to our net income number. And you can see we report it here both on a GAAP and non-GAAP basis. We have our total shares outstanding, and we use that to get back to our diluted EPS on a non-GAAP basis here, which is simply the net income non-GAAP divided by the total shares. So then we can scroll down below our segment details, and you'll see we have the balance sheet there. There's a number of balance sheet account items that are shaded in blue, and that's because it's too difficult to project these out in future periods. So we simply set it equal to the ending balance at the end of the prior quarter. Below that we have the cash flow statement, and then we get to our valuation section. So our multiple valuation is based on a forward price earnings ratio. And what we've done is we take the closing price each day and we subtract out the net cash, and in this case we're adding back the net debt per share. And then we divide that by the next 12-month consensus EPS estimate to come up with our multiple. And we show the average multiple, the high multiple, and the low multiple over the last 3 months. And we use the average valuation multiple in our price target here. And you can see if you click on the cell that all this does is it takes that multiple and it applies it to the EPS estimates for the next 4 quarters. So you can see at the bottom of our income statement, 1, 2, 3, 4, and then add back the net cash or net debt per share. And that's how we get to our $85 price target for the PE multiple. Now the discounted cash flow valuation approach is a bit different. There's a number of inputs into this calculation. First we have to calculate the weighted average cost of capital. We apply that to our stage 1 cash flows, which represent the next 5 years of cash flows. And then we take an estimate of our terminal value, which is essentially a perpetuity based on our constant growth stage for the company. If you want the details on how this discounted cash flow valuation approach works, please visit our website, gutenbergresearch.com, and there's a video there that describes it. So that's the summary. If you'd like to download this model, visit our website, click on the model store, and then scroll down to the Yum Brands model. From there you can just click the Download Now button, and you can put in some assumptions for yourself. Thanks for watching.